Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, August 19, 2015. Well, what a wild day today it was in the market. We were down, we were up, we were back down. This is basically what you can expect in terms of volatility going forward for the next couple of months. Now, let's talk a little bit about time and price. As you can see here, we've had this triangle in here for a long time, and you can see what happened. We tried to pop out of it, and yesterday we came down and tested it, and we closed on top of it. But if you remember what I said last night, okay, and in fact, let's go to a 60-minute chart, and I want to point something out that's very important. Last night I said, based on the light volume that we had yesterday and the fact that the market was basically floating around most of the day, but could not close above 210.06, which is this horizontal trend line here, the purple horizontal trend line. Although we closed on top of the triangle, I said the fact that we couldn't close above that had me concerned, and that had my bearish antennas up, if you will, because on a light volume day, and yesterday was extremely light, on a light volume day, you would expect the market to at least be able to close above that support level, and it couldn't do it. And what happened today? We had a gap down. We came in to test the bottom end of the triangle, or the bottom portion of the triangle, and this lower trend line at 207.80 down here, pierced through it a little bit and then popped back up. And the Fed announcement came out and they whipped the market up to the top of the triangle, and then it failed and we settled in close to the middle. Let's go back to the daily chart. Now, if you just closed your eyes, okay, and you didn't pay attention to the news and you didn't pay attention to the Fed announcement or the minutes that came out, that's what it was, the release of the Fed minutes from the last meeting, and you just said, well, what happened today? You'd say, the market was down a little bit, and what was the reason? Well, the funny part was, this morning, nobody could come up with a reason why the market was down. I found that fascinating. They were looking around. Maybe it was China. China was down 6%, and then it came all the way back. Nah, that didn't work. So they looked at, well, maybe they're nervous about the Fed minutes. That didn't really work. Who's nervous about the Fed minutes? You know what they're going to say. They're going to say we're dependent on economic data, and the data is going to tell us what to do, and maybe there's a rate hike in September, maybe there's not. But the reality is that there's no rate hike coming in September, and there's two reasons why. Number one is we're addicted to low interest rates, and when the market falters and the market gets this kind of like the EKG thing going that's going on here, up, down, up, down, up, down, the Fed is very reluctant to make any kind of a move because they don't want to upset the apple cart. That's just the way it works. The second reason is that if you look at the bond market, and we're going to go over that in a few minutes, the bond market has been telling us without a shadow of a doubt there's no rate hike imminent, and that's basically the real tell. The bond market, and I've told you this many times, the bond market is way smarter, way larger than the stock market. The stock market is pittance compared to the bond market, okay? So when we want real information, we want real data, we want to know what's really going on, we pay attention to the bond market. And we'll go over that in a few minutes. Let's get back to the SPY, and we'll go over to the E-mini in a second. So here we have the green dotted line here at 208.40. Now that number that's been in here for quite a while, just like this triangle's been in here for quite a while, and the market closed below that number today. Even after the rally all the way up, and we came up short of the 210.06, we came up to 210.01 today on the high, and then we failed, and we closed all the way back below 208.40. Okay, that number's very important. But the solidification for me, okay, at least in the work that I do, is the close today below 2100 on the E-mini contract. In fact, it was even a worse close than that. I'm going to flip over for a second and go back and forth on you. I apologize. The fact that we closed below 2100, and I told you that last night, if we close below 2100, and I sent out an email earlier today, close below 2100 is going to be bearish for the market, okay? It's going to support the bearish case. A close above 2100 is going to put the bearish case on hold temporarily. Okay, but that didn't happen. We closed well below. Well, the market, I'm doing this video a little earlier than normal tonight. Market's still open for a few more minutes here. The E-mini contract's open for a few more minutes, but it's not going to close above 2100, that's for sure. So That's another bearish sign. The other one is the 2078 that's been in here for what seems like forever. Okay, I don't even know how long. It's been in here for weeks. And those of you that have been around for a while know that this line has been in here for a long, long time. And as you can see, all we've been doing is pivoting around this number. Okay, we keep coming down to test this number. Okay, eventually it's going to break. Let me go back to the spider because I want to talk about something else. Two more things. Okay, what else is going to break on the spider? Okay, the 200 period moving average was tested once again. Okay, this was the 7th test, and now this was the 8th test, I think. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I was wrong. It's 10. The 10th test of the 200 period moving average. I don't know how much more it could take. Eventually, it's going to break, and it's not going to come back anytime soon. Okay, the other thing I want to talk about, and I keep telling you this, and I get some questions on it, and they're good questions, and I appreciate the questions. So let me address it to everybody else. I keep saying we're running out of time. What do I mean by that? I talked about it last night. I'm going to talk about it a little bit again tonight. Just going to put a little bit of a different spin. I'm going to put a visual spin on running out of time. Okay, let me do this. Watch this. We're running out of time. Okay, you see where this triangle pinches together? That's it. That's as much time as this market has to decide which direction it's going, one way or the other. Okay, and if it breaks up, okay, I still have a huge amount of resistance up at 212. Is that still possible? Sure, it's still possible. This is still options expiration week, and anything goes. We know that. I've told you that. And if we close above 213.18, which is all the way up here, then I'll reevaluate, and there might be higher prices at hand. Okay, as it stands now, if we break lower, okay, and let me do this one more time. I did this pretty much every night. If we break lower, we're going lower. Okay, if we break to the bottom side of this triangle, we're going lower. Okay, where do we go? At least right here. Maybe lower by $1 or so, but our first target is going to be 202 on the spider. Now, what happens when we get to 202? Well, normally, under normal conditions, if we get to 202, or when we get to 202, it's really 201.92 is the number that I've got this green line in at. Once we get down here, you're probably going to see a multi-week bounce. It's going to be scary to buy. Everybody's going to be saying we're going to zero. There's going to be lower numbers coming out of all the analysts. They start to get short. They start to change their opinion just at the point in which the market is going to hit a low. They did it here, over here in this area. Okay, once the market got down here, all the bears come out. All the bearish sentiment comes out, and what happens? Market rips higher. Okay? What happens here? All the bulls come out. What happens? Market rips lower. And if you've been with me for any period of time, you know that we've been able to play that, okay? That was not a problem for us, but it's a problem for everybody else. Okay, same thing's going to happen down here. Once we get down to 202, 201.5, 201, it depends on the velocity in which we come down to that number. But once we get there, okay, we're going to be buyers at that level most likely unless something changes. But as it stands now, once we get down to that level, we're going to be buyers and everybody else is going to get real bearish. Once the sentiment gets real bearish, what happens? The market usually rips higher. And that's what's going to happen, okay? How high is it going to go? We'll know it when we put in a bottom here, and the velocity that we can experience off that bottom will tell us how high the market is capable of going off that bounce. Maybe we get to the underside of this triangle again. Maybe we get to 206.5. I don't know. We'll see what happens when we get there. We haven't even broken down yet. So there's a lot of work to be done, and we have to confirm on the downside. But until we close below and confirm below this triangle, and I'll know it when I see it and I'll let you know, until that happens, until and unless that happens, okay, we're still in that time zone where we're just buying our time. We're running out of time. The market is, I'm going to do this one more time. The market is running out of time right here, okay? It's going to make a decision right here or before, okay? Could have been today, wasn't today. We're still just in the middle of the triangle. As crazy market as it was today, what was today? Today was a Whipsaw Wednesday. The Wednesday of options expiration week is Whipsaw Wednesday. Okay, so this was not that it's expected the type of volatility we got today, but not surprising the type of volatility we got today. So there we go. That's the market today. Let's take a look at the, let's look at the IWM real quick because it's important. The IWM still remains the weaker market, okay? It's much, much weaker than the Spider. It's much, much weaker than the Dow. It's much weaker than the NASDAQ. What is this? This is, if I just look at the bigger picture, this is a down move, sideways, getting ready for another down move. Could we go higher? Sure. We've got a lot of resistance here. We've got a ton of resistance here. Okay, I don't even know if we get there. We got a lot of resistance here. I don't think we get there, but we could get up to the 122 and a half. I think that's the number here. Maybe I think that's 122 and a half roughly. High 123. It's 123.71 to be exact. I'm sorry. So we could get up to that level. But as it stands, each and every day that goes by, it becomes less and less likely. Okay, let me show you a bigger picture on the IWM. You see this big uptrend? Okay, once we get to this level here, you're going to see a bounce in the IWM. This number is farther away than it looks from here. Okay, but it's really going to come in at about, let's say it's going to come in at about 116, maybe overshoot it a little bit, 115 to 116, in that neighborhood. Once you get to that level, you're going to see a bounce in the IWM. We're at 119 and a half, 119.41. That's a ways down in the IWM. If you think about it, another $4 or $5 in the IWM, okay, is going to equal probably the $5 or $6 in the SPY, roughly, that we're looking for, and that's going to be a good bounce level for both markets. So I'm watching, and we'll see it. We'll know it when we see it, no question about it. But you can see this. Here's a little hint of that line here. It's about 115 and a half, 115.75. It overshoots a little bit. Maybe it gets down to 115. But once you get down there, okay, and the Spider is getting down to that 202, 201.92 level, everything's going to get real bearish. That's when we're going to look for a bounce. Okay, you have to be a contrarian in these markets. Most of the people are wrong most of the time. You got to understand that. Let's look at the transports real quick. Transports, as it stands right now, is still in a bullish consolidation pattern. But when and if, or if and until and unless we get below this level right here, this downsloping trend line, okay, the market still has a propensity to hold up. But we broke it once here. Okay, this was, I believe, on the 12th of August. Okay, let's just double check. Yep, the 12th of August, we broke it here. Once this breaks again, it's probably not going to hold. Okay, once this bottom here and this bottom here is taken out, let me just show you the transports. Let me pull back and show you a weekly chart. Okay, you see this? Okay, where's your next level of support in the transports? 76.88. We'll just call it 76.50 to 76.85, 7,700, in that number, okay, or in that neighborhood. And what's the actual low? Sorry about that. The actual low is 7,700, okay? 7,700 on the transports from 8,300 where we are now. That's a pretty good fall. 600 points on the transports is our next target, okay? In fact, we're going to put that in, okay? Bear with me. $7,700, all right? Let me save that so we have it in there, okay? We'll have it in there for quite a while. All right, so that's our next downside target in the transports. You could see how all these targets on the downside all coincide with each other. The target on the transports in terms of percentages and the amount down is going to coincide with the IWM, which is going to coincide with the Spider, and all that stuff. It's all going to converge together, okay? All right, enough with the market. Let's go over to the gold market. Look at this. What did I tell you? Let me go to the shorter time frame, the daily chart. I told you that this was a bullish pattern forming, and I told you that starting tomorrow, this was yesterday, that you're going to look for the upside to begin in gold. What happened? The upside began in gold. 1144 is the first upside target, probably going to get overshot because of the 1150 is like a round number. The market's going to have a propensity to get to that rounder number. My mathematical target was 1144. That was a good math target, but in reality, you're probably going to overshoot it, pierce through it, and then it'll pull back, and the market will trade like this, okay? Here. It'll trade like this. It'll come up, it'll pull back down, then it'll go up again. In fact, I have another target on the upside, 1144. We'll call it 1150 to be fair, and then actually 1195. So let me put that in. Okay, let's start putting some additional numbers in because I was doing the math today because of what was going on. So 1195. All right. You'll probably get to the round number of 1200, maybe not. But you can see where all this chart support is. This is called vibration in the market, and you can see how the market fights around, in and around, up and down this number. Okay, maybe it's 1197, maybe it's 1200, maybe it's 1192. My calculator tells me 1195. But you could come up short and you can overshoot by a little bit. I give you these numbers as a guide. Sometimes they hit them spot on, sometimes they don't. You see this 1089 down here, traded around it. You see the 1105, okay, trade around it. You see the 1112, trade around it, okay, pierce through it one day, up and above, back down to test it, 1111, 1112, 1110. Okay, it's a guide. Okay, but what I do with the guide is I give you something to trade against. Okay, so had the big up move, and I said 1, 2, 3, 4, 5. I said tomorrow, this was yesterday, you're looking for the beginning of the up move, and here it is. Okay, right on target, right on time, spot on. Okay, so we're still going to look for higher prices in gold. Don't be afraid of a pullback, okay? And that's the hard part, staying in a trade when a pullback occurs. You could see a $10 pullback tomorrow, and that's nothing other than consolidation, okay? Maybe you go like this, then you have the up move, sideways, another up move. I show you this dozens and dozens of times. It happens over and over again. So what I do is I try and teach you not to be afraid of the pullbacks. The pullbacks are healthy. They're normal. It's normal market behavior. Okay? Let's go to the GDX. I know some of you like the gold mining stocks. And from down here, I was giving you the targets. I said, you know, you're going to get into resistance at this gap window, gap fill, which is here. Okay? Let me draw it in. I said the first resistance was going to be here. That happened. Okay, then you're going to have resistance here, and then that happened. So now what does it look like? All it does is it looks like this. Okay, and you know what I'm going to show you. Up move, sideways consolidation, another up move coming, and you saw the beginnings of that today. Okay, so where does this take us? 17 and a half. All right, let me put that in, and we'll keep track of that for you. Let's put it in at 17 and a quarter as a guide. Okay, 17 and a quarter. Okay, and that'll be mainly our near-term upside target. It could be 17, but it'll be a guide. Okay, we should get up into that area as the price of gold moves towards the $1,150 area, 1144, 1145, in that neighborhood. Okay, let me save that so we don't forget. All right, now let's go over to the oil market. Now, I was in an oil trade, and I got out earlier this morning, and the reason is because it doesn't work. It's just not working. There's a very, very good level of support we're at right here, but I'm not interested in oil right here. I'm not going to try and pick another bottom. It's not important to me. I don't like it. We're rolling contracts tomorrow. Tomorrow, the contract, I believe tomorrow, the contract expires for the September crude contract. We're going to roll over to October. Can we see a spike up? Yeah. Today was probably the spike down on the near-term expiration contract, and then what happens is you're going to see probably a spike up tomorrow. That's okay if it goes up without me. I don't care. I took a small loss on the trade, and I told you everything I was doing, and I just wasn't interested. Once we came back down below this level, I'm just not interested in it anymore. It's not important to me. The fact that I moved out clears the way for anybody else that's long. You'll probably see a bounce, and the bounce could still take us up to $45 a barrel, no problem. But I'm just not interested in the oil trade right now. I want to see a pattern that I can trade off of, the kind of patterns that I keep showing you. I want to see a high volume reversal day, and maybe we get that tomorrow. And if we get a pattern off a high volume reversal day, then I'll trade that, no problem. Okay, I want to see a high volume reversal day. I want to see a high volume doji candle with make a low, and then we finish either at the open and the close and the open are at the same number. That's a doji. And then maybe we come down the following day with a test candle halfway down, and then we take off to the upside. Or we have an engulfing candle where we engulf today's candle with a green candle engulfing and finish near the highs. On volume, that would be a high volume reversal day, something like that. And I'll show you when we see it. Okay, like this candle here, okay, would be considered the type of high volume reversal day I'm looking for. Something like that, something like this, where it takes out the, you see this here, these two candles together. Something like that would qualify. But for me, I'm just going to let the market play out. And if I see a pattern that's tradable, I'll let you know. Before that, I'm not interested. Let's go over to bonds. Oh, by the way, if you want, let me just give you the numbers, by the way. On the October contract, I worked out a number which was, actually, I think we're at it now, 40.90. Isn't that ironic? I didn't even realize that. 40.90 should be the low in oil. In fact, I'll put it in and we'll see if that plays out tomorrow. 40.90 should be a good low, okay? But this is, again, a mathematical number. It's not a chart pattern number. It's a mathematical number. I'd rather trade off a chart pattern. We should not see, tomorrow, we should not see the market close below 40.90. If the market closes, even trades hourly below 40.90, then that math is wrong. But if we open above it tomorrow and we trade above it, then that's probably a good low, but it's not for me. It's for anybody else that wants to trade oil. It can go ahead without me. I have no problem with that. So let's go with the bond market. Here's the 30-year bond. And with the 30-year bond, what I've been telling you is that unless we closed below, okay, this level here, okay, then I was going to say that we're still in an upward bullish pattern waiting for higher prices. And that's what I believe is here. Okay, until we close below really this area here on a daily chart close, daily chart closing basis, then all this is to me is bullish consolidation waiting for another move higher, okay? So I don't think, and by the way, now I told you before that the bond market was telling us that the interest rates are not going to be raised in September, okay? We're not going to see a rise in interest rates. This is it right here. When you see bond prices trading in a pattern that's telling you higher prices today, we spiked lower and the market turned around and closed higher and took out, this is basically an engulfing candle. You can use this as the example I was trying to show you before. This is an engulfing candle to yesterday's number, okay? You see here, we had a red candle yesterday, and then today we traded lower and then closed on the highs. This is an engulfing candle to yesterday's candle. Okay, this is telling you that all we're seeing is an up move, sideways consolidation, waiting for another up move. If we close below this area, then this pattern's off the table. It's just that simple, and that's the way you trade. You see this test candle today? All that did was come down and test around the lows that I'm talking about, turned around and traded higher. The bond market wants to go higher. Yields want to go lower. Okay, this is the TLT that we talk about, and you can see this here. Same thing, nothing new. It's the same thing. It is the bond market. Higher, okay, up move, consolidation, came in, tested, came up short of the 20-period moving average, which is the upsloping trend line, waiting for another up move. Okay, all this is doing is telling us that yields, and this is the 10-year yield, okay, the 10-year Treasury note yield wants to go lower, okay? The yield is at 2.129. That's a low yield, folks. It's telling you that the Fed's not going to raise interest rates. 30-year yield, 2.819. Okay, this is telling you yields want to come lower. This is a bearish pattern on the flip side of the bond market, a bearish pattern consolidating for a move lower. Okay, that's all this is. I show you this dozens and dozens of times. It works out 70 to 80, 85% of the time. You've seen this over and over and over again. Here's the dollar. Okay, I thought we were going to see higher prices in the dollar, but what happened? I told you unless we could close above this candle here, which was at 97.375, 97.375, then that was going to be a failure, and this was going to be considered a bearish pattern. What happened? Bearish pattern, lower prices coming. Okay, this stuff plays out 70, 75, 80, 85% of the time. It's happening right before your eyes, over and over and over again. Okay, we're probably going to come down and test the 96.15, and if that doesn't hold, we'll come down and test the 200 period moving average. And if we come down into this area here, that's the buy area that we're looking for, that we've been looking for a long, long time. Actually, this was the buy area, but we'll know it when we see it. I have to recalculate that because we've been so far above that area. I have to check the math on that. We'll worry about it when we get there. We're nowhere near there now, so we're not in a buy zone for the dollar, but we could get there. Last one tonight will be natural gas. Okay, natural gas held yesterday's low. Okay, any of you that are long natural gas, you're still holding yesterday's low. Natural gas tried to make a move today. Let me just show you the intraday chart. I'll show you the 10-minute chart. You see, we tried to make a move. Where was this? This was, tried to make a move. And what is this showing us? Okay, this is showing us a bullish pattern. Okay, so don't be scared of this. Okay, what's this telling us? Higher prices are coming. Could you come down and test lower numbers? Sure you could. Absolutely. Okay, but as long as you stay, let me go to the daily chart, and then we're going to give this a wrap. As long as you stay above, specifically now, 268, then you're probably going to try and get back into this channel. But you took a test of this channel today and failed at the underside of this channel. So, it's a little bit of a precautionary move here. I wouldn't necessarily want to be long natural gas until you really got inside this channel, but you can still be long against yesterday's low. Okay, do I think we're going to get into this channel? Yeah, probably most likely. As long as, even the fact that the dollar's probably going to move lower should push the price of natural gas higher, and that should also have the same effect in oil. But against yesterday's low, worst case, this low here, which is the low is 2.656. As long as you have a stop in those zones, then you could look for a push into the channel here. Okay, and I think we're going to roll over to October as well. And once we do, tomorrow I'll show you the October chart. The numbers will change, but the channel will look the same. Okay, that's it for tonight. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.